Hello students, welcome to my class. This is Professor Vicente Sire and this is part 3 of chapter 20, Accounting for Pensions and Post-Retirement Benefits. We left off in part 2 and we indicated that we are going to start part 3 with how to calculate pension expense. We said that unlike other expenses that are very straightforward to determine, we have 5 different components that make up a pension expense. So pension expense is relatively complicated in relationship to other types of expenses. Now, let's take a look at the 5 components of pension expense. Number 1, this is the service cost. So here, the actual present value of benefits attributed by the pension benefit formula to employee service during the period. What does that mean? The actuarist will calculate the present value of the benefits that are due to the current service that the employees are contributed in the current period. So we call that service cost. In other words, here we are computing the present value of the benefit that the employees are going to receive in the future based on their current service. Again, like I said, that is service cost, and obviously it's a plus on the pension expense. In other words, the effect on expense is positive. Moving along, the second component is interest on liability. So this is the interest for the period on the projected benefit obligation outstanding during the period. Remember, we indicated that the fair value of the pension plans and the projected benefit obligation, the difference is underfunded or overfunded pension plan. So we have to calculate interest on that liability or on the projected benefit obligation. Whatever that interest is, obviously is a plus to pension expense. And the rate that we use in calculating the interest is called the settlement rate. Now let's take a look at part 3. We call this the actual return on plan asset. So this is the increase in the pension fund. Okay, remember we said that the pension fund consists of different financial securities, i.e. stocks, bonds, so on and so forth. So the interest, dividends, realized and unrealized changes in the fair value of the plan is also another component of pension expense. Because the actual interest could be, or the actual return could be negative or positive, so the effect on pension expense could be positive or negative. Now let's take a look at number 4, amortization of prior service costs. This is called plan amendments. This is called plan amendment. What often includes provision to increase benefit for employee service provided in prior years. What does that mean? Listen to this very carefully. So this is a situation whereby the pension plan or the employer and employees case said, wait a second, 10 years ago, we should have done this to benefit this group of employees in terms of their future retirement benefit. For one reason or the other, it was not done. So the plan is being amended. So when we amend the plan, now we are not going back retroactively to do the calculation. So whatever that amount is that they are entitled to, that we should have calculated in the future that we did not calculate, we call it prior service cost. And the prior service cost cannot be charged 100% to this current year. We have to spread it over the remaining service years of those employees that we affected. So we say we have to amortize the prior service cost over that period. So that is number 4 component. The effect on expense or pension expense is a plus. The last one is the gain or loss. The volatility in pension expense can result from sudden and large changes in the fair value of pension assets and by changes in projected benefit obligations. So what are we talking about here? Of course, the plan asset consists of different financial securities. So the gain and loss has to be computed, and the changes in the projected benefit obligation has to be taken into consideration. So the gain obviously will be a minus to the pension expense, and the loss will be additional pension expense. So this component can result in plus or minus depending on the situation. So those are the 5 components of pension expense. So let's take a look at how we cleverly use a worksheet to determine the pension expense to help us make an accurate journal entries relative to pension expense. Remember, in accounting 110, we also use that big spreadsheet. We have the first column is the unadjusted trial balance. The next 2 columns will be for the adjustment. So we use that spreadsheet to facilitate the preparation of the financial statement, to make the preparation of the financial statements as easy as possible. So that is what we are doing here. We are using this worksheet to help us prepare the journal entries or account for pension plans with as much ease as possible. So moving along, let's take a look at how that works with this fast. So on January 1, 2014, Z Company provides the following information related to its pension plan for the year 2014. The plan asset at the beginning of the year is $100,000. The projected benefit obligation at the beginning of the year is also $100,000. The annual service cost, remember that is the first component of the 5 components of pension plan or pension expense, is $9,000. The settlement rate is 10%. Actual return on plan asset is $10,000. Funding contributions for that particular year is $8,000. The benefits paid to retirees during the year are $7,000. So we are going to prepare this worksheet to enable us make the pension plan expense journal entry with ease. So here is the worksheet. Take a look at what we have here. The first row of the worksheet. The projected benefit obligation is $100,000. The plan asset is $100,000. So therefore, right here, the plan is not underfunded. It is not overfunded. We have $100,000 in plan asset. The projected benefit obligation in the future is $100,000, so we are even. So let's take a look at what happened. For that current year, we have $9,000 in service cost. All right. So that $9,000 increases the projected benefit obligation. All right. Now let's take a look at the next line, interest cost. So we are going to calculate 10% of the $100,000. That will give us $10,000. So this interest cost again increases the projected benefit obligation. Now let's take a look at the actual return. The actual return is $10,000. So that is good news. So the actual return is going to decrease the pension expense, and of course it is going to increase our plan assets. Now let's take a look at the contribution. That is what the company is contributing in the current year, and that is they covered $8,000 cash. That cash obviously increases our plan asset, and of course we have a column here for cash. Now the benefit paid to retirees this year is $7,000. So that $7,000 obviously decreases our projected benefit obligation. All right, and then that $7,000 also decreases our plan asset. So take a look at what happened here. So if you add up all the expense, you have $9,000. The cash that we covered is $8,000. So we have a liability here. So we have a liability here because we covered $8,000. Our pension expense is $9,000. So if you take a look at the memo column, take a look at the projected benefit obligation. We have $112,000. The plant asset is $110,000. So there is a $1,000 negative net liability. So let's take a look at the journal entry. Pension expense $9,000 as calculated in the worksheet. Then cash $8,000. Then we credit pension asset / liability. Even though we have pension asset / liability, this is actually a liability. So the liabilities went up by 1,000. Moving along, let's take a look at the amortization of prior service cost. All right. So, like we said earlier, the company should not recognize the retroactive benefits or the benefits that they would have been, the employees are entitled to in the past that we are not taking into account, that we are trying to figure out right now. Cannot charge it to this year and this year alone. So we have to amortize it over the years in which the employee are expected to benefit from it. So, so let's take a look at how that works. We are going to use the amortization method. The board prefers a years of service method. Employees may use straight line amortization over the average remaining service life of the employees. So I think this would be a good point to cut off part 3 of this presentation. So we are going to illustrate how prior service cost is amortized in this illustration and wrap up the remaining part of chapter 20. So this is the conclusion of part 3.